Welcome to Key Points for October. This month we look at the further deterioration in global manufacturing and what that means for the broader economy. We give our view on the fairly profound cutting of interest rates by central banks and whether this will be enough to avoid a global recession. And of course, as usual, what all of this means for financial markets. Now, turning to our first point, the latest manufacturing data show that there's been a further deterioration in what was already a very weak sector. The latest data from the United States shows that manufacturing and new orders is now moving into contractionary territory and following the same path that we had seen in both Japan and the Eurozone. In China, activity is very much under pressure, both from the slowing domestic economy and, of course, from the trade situation, which has again continued to soften. Now, the important thing is there is a correlation between manufacturing and the broader service sector with a bit of a delay. And we're already seeing signs that this is beginning to transmit. Germany has been particularly badly hit on the manufacturing side, and now we're beginning to see this spill over. So we're seeing the labour market begin to soften, consumer sentiment has actually plunged quite significantly, and of course this will have an impact on spending and broader sentiment more generally, something that we think could transmit to other parts of the world as well. Now, turning to our second point, given this sort of poor backdrop, it is quite profound that these central banks are really slashing interest rates almost in a race to the bottom, and this is very much a good thing. However, will this be enough to avoid recession? We suspect it's probably not going to be enough, but it will certainly soften that outlook. The latest central banks have been the Fed, where they begrudgingly cut by 25 basis points and offering not a great deal of insight into what comes next. But the ECB, with Mario Draghi's parting shots, being really the full gamut of measures to try and stimulate economic growth in that region. So not surprisingly, we saw rates cut further into negative territory, now minus 50 basis points. We saw measures such as the tiering for the banks to try and soften that negative impact, so allowing the banks to have some kind of cushion and not be charged the full amount with the excess reserves that they hold with the ECB. TLTRO3 was introduced to try and make it a little bit easier for the weaker banks to access the cheap funding. But perhaps most importantly of all, we've seen a reintroduction of quantitative easing. 20 billion will be bought a month, but this will be done on an open-ended basis with no time constraint. So really continuing until the economy, or in the case of Europe, inflation gets back up towards target. So this is quite significant, we think. Having said all of that, there is a significant change between policy today versus a year ago when a lot of these central banks were tightening, and therefore this switch, which is profound, we think will help to encourage growth, but we still forecast a mild global recession for 2020. Now, of course, turning to our third point, from financial market perspective, there's mixed impacts from this. You'll remember last month, we spoke about a window of opportunity for stocks, and that has really largely played out as we had hoped. We're getting up towards resistance levels, and we think there's a bit of a binary outcome here that will be centered around trade. If the US and China manage to thaw relationships or strike any kind of deal, we think these equity and credit markets could push higher. If, however, as we've seen over the last year or so, there is a disappointment, we suspect that they will not be able to break out and in fact consolidate or even fall further. So a binary outcome that we think will require caution. Remember that you can read the full report along with an additional report on the ECB easing and what this means for the banks on zurich.com/MSME.